Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and before we really get into the weeds on this one, we want to mention StockOracle.
Right, StockOracle. We actually have a special 14-day trial link below in the description for you guys.
Exactly. It's an AI-aided stock research platform. Just to be clear, it is not financial advice, it is not a trading signal service, and it doesn't give you real-time market data.
Yeah, and that link is an affiliate link, which means the channel may earn a commission at no extra cost to you.
And remember, StockOracle's AI insights and their valuation estimates, well, they can be incomplete or just downright wrong. So always, verify important facts for yourself.
Always. Okay, so setting the stage here for BigBear.ai, ticker BBAI. Imagine operating in literally the hottest tech sector on the planet right now.
Generative AI for national security.
Right. And you've got like $400 million sitting in your bank account.
I mean, on paper, that sounds like an absolute guaranteed win.
You would think so. You picture endless defense contracts, cutting-edge tech, huge government budgets. But their stock price has actually been slashed in half over the past year.
Yeah, it's a massive paradox, honestly. You have a company in this red-hot sector, but the engine on their whole hype machine is just sputtering.
Exactly. And that disconnect is what we are unpacking for you today. We need to figure out if this defense AI company is like a hidden gem ready for turnaround or if it's an overvalued trap.
Yeah, a trap where they are just struggling to swallow their recent acquisitions.
Right. So let's start by looking under the hood at the financial engine. What did their recent Q2 2026 performance actually look like?
Well, if you only look at the headlines, it paints a really optimistic picture.
Okay, lay it out for us.
So in Q2 2026, they reported a 13% year-over-year jump in revenue. That came in at $36.7 million.
Which sounds solid, right?
Yeah, and a massive driver of that growth was their acquisition of a company called Ask Sage.
Ah, right. Ask Sage.
Yeah, which basically bolted highly coveted generative AI platforms right onto BigBear's existing infrastructure. Plus, their gross margins expanded massively.
Like how massively?
By 781 basis points. So they hit a 32.8% gross margin.
Oh, wow. Okay, that's a huge jump.
They also reported a 9% growth in their backlog, bringing that to nearly $270 million and over 20 new contract wins.
Okay, wait, I need to stop you there. The gross margin expansion is interesting, but we have to look at the whole board here.
Oh, totally. There's a catch.
A huge catch. Because when you zoom out to a trailing 12-month basis, the growth story just completely falls apart.
It really does.
Like, revenue actually shrank by 13.72%, and their net margin is a brutal negative 65.2%.
Yeah, that negative 65% is tough to look at.
It is. So here's the specific thing that just does not compute for me. How can a company expand its gross margin so significantly but still report a non-GAAP adjusted EBITDA loss that actually got worse?
Right, dropping from negative 8.5 million to negative 11.6 million.
Exactly. How does that happen at the operating level?
Well, that discrepancy is where the narrative hits the friction of reality. The financial bleeding isn't happening at the product level.
Okay, so where is the CAC going?
It is entirely below the gross profit line, mostly concentrated in SG&A, so selling, general, and administrative expenses.
Got it.
Yeah, they had a massive $10.4 million increase in these costs. And you kind of have to split that expense into two categories to understand it.
Okay, break that down for me.
First is non-cash. When they bought Ask Sage, they acquired intangible assets. Proprietary code, customer lists, that sort of thing.
Right, and you have to amortize that.
Exactly. Accounting standards force them to slowly write off the value of those intangibles over time, which drags down profitability on paper.
Right, so that part is just an accounting mechanism. It's a paper penalty. The money isn't actually leaving their bank account today.
Right, but that doesn't account for the whole $10 million increase. The second category is hard cash out the door.
And that's the vulnerability.
Totally. They saw a massive spike in legal fees, proxy expenses, and just the structural costs of expanding their sales teams to actually push this new product.
So they basically bought top-line revenue by acquiring Ask Sage, but integrating it is just burning massive amounts of upfront capital.
You nailed it. The legacy business underneath is struggling, which explains that trailing 12-month revenue decline, and the new business is just incredibly expensive to maintain.
It's like they bought this highly advanced Gen AI engine, but it doesn't fit into their current car. So they're spending millions just to get it running.
That's a great way to look at it.
Which really brings up the whole concept of a competitive moat.
Yeah, the defense sector is brutal for that.
It is. I mean, think about the massive primes, like your Lockheeds or Palantirs. They don't have to spend exorbitant amounts on marketing to get a meeting at the Pentagon. Their relationships are entrenched.
Right, they own the room.
Exactly. BigBear.ai has the flashy tech now, but this SG&A bloat tells me they lack the structural moat to deploy it efficiently. They are paying a huge premium just to get a seat at the table.
And that's the structural disadvantage of being a mid-tier player. Because that cash burn is intensifying, the immediate question becomes, well, how long can they endure a $12 million quarterly deficit?
Yeah, financial stamina. Let's look at the balance sheet then, because this introduces probably the most baffling contradiction in this whole setup.
Oh, the cash versus dilution issue.
Yes. On one hand, Big Bear has a surprisingly solid war chest. As of June 30th, 2026, they have almost $410 million in available cash and investments.
Right, which for a company burning $12 million a quarter, that gives you a runway of years.
Years. But then, literally a month later on July 31st, they file an ATM offering agreement,
At the market offering,
giving them the right to sell up to 100 million new common shares.
which is massive.
It's huge, with a market cap around $1.44 billion and a stock price around $3.27. Executing that ATM would dilute existing shareholders by like 18 to 22%.
Yeah, it's a heavy hit.
It's like inviting 20% more people to a pizza party without ordering any extra pizza. Your slice just gets smaller. So why on earth would a company with $400 million in cash need to threaten 20% dilution?
Well, to understand the motivation, we have to look at the mechanics of an ATM. It's different from a traditional secondary offering where they sell a massive block of shares all at once.
Right, an ATM is more like a drip feed.
Exactly. The company hands shares to an investment bank, and they sell them into the open market gradually at whatever the current price is on any given day.
So it's designed to be a stealthy way to raise capital without causing a single dramatic price crash.
Yes, but stealthy or not, it's still dilution.
Exactly. So what does it signal when a cash-rich company sets up the machinery to print that much new stock?
Honestly, it signals extreme precaution or a desperate need for future capital flexibility. They might be looking at potential defense budget cuts, or maybe they're lining up another massive acquisition.
Either way, it creates a massive structural overhang on the stock for you as an investor.
It really does. If the stock price spikes on good news, management is heavily incentivized to just start selling shares into that strength.
Right. They become a seller of their own stock, which just crushes the momentum.
And markets hate that specific type of uncertainty.
So we have deteriorating operating losses, no clear moat, and the threat of a 20% dilution. Let's pivot and see how the market is actually pricing this reality.
The technicals and valuation multiples are pretty glaring here.
Yeah, Big Bear is trading at a price-to-sales ratio of 10.96.
That is an incredibly rich multiple.
Right. I mean, a PS of 11 is usually reserved for hyper-growth software companies with pristine margins. The market is pricing in future success that the fundamentals just do not support yet.
Yeah, it's an aggressive valuation for a company with negative trailing revenue growth. And the chart analysis confirms that gravity is kind of taking over.
Definitely. The stock has been in a severe long-term downtrend, down about 50.5% from its 52-week high of 9.39.
It even hit a death cross back in February 2026.
Right, where the 50-day moving average drops below the 200-day. It's a huge warning sign for institutional algos.
Yeah, it mathematically confirms that the downward selling pressure is stronger than the historical baseline.
But, and this is where it gets weird, recently the stock posted a sharp 14.3% 5-day gain.
A sudden rebound, yeah.
Yeah, pushing it slightly above its 20-day moving average to 3.27. And while analyst sentiment is overwhelmingly bearish, I mean, they are cutting price targets to 4.0 and 4.76. There is this counter signal.
The insider buying.
Right. Company insiders have bought 190,081 shares over the last 90 days. So you have a 14% price surge and insiders buying. Are we looking at the setup for a short squeeze here?
I would caution heavily against that interpretation. If we connect this to the bigger picture, it is highly speculative.
Why is that?
Well, the volume on that 14% upward move is actually sitting below the 3-month average. It's at like 0.83x.
Ah, so it's not confirmed accumulation by big institutions.
Exactly. When a stock jumps on low volume, it's usually just retail speculation or short-term traders covering positions. It's not a fundamental shift in conviction.
And I guess 190,000 shares bought by insiders is a tiny drop in the bucket compared to a $1.44 billion market cap.
It's a mathematical rounding error, and it does nothing to offset the 100 million share dilution threat from the ATM offering.
Okay, so the stock is beaten down but showing tiny signs of life. What are the specific catalysts you should be watching for that could break this stalemate?
The ultimate test will be their Q3 2026 earnings report, coming up in late October or early November.
That's the show me quarter.
Exactly. They have to prove that the pain of integrating Ask Sage is yielding actual operating leverage.
So they need to show that those 20-plus new contracts from Q2 are actually converting into revenue.
Right. Backlog is just contracted money. The deployment can get delayed by security clearances or frozen government funding. Q3 is about seeing that $270 million backlog convert.
And they also have to show that EBITDA losses are narrowing.
Yes. They have to prove they can scale without their administrative expenses bloating even further.
Now, management has also signaled plans for, and this is their phrase, accretive catalytic M&A in the second half of 2026.
Yeah, they want to capture those macroeconomic tailwinds from U.S. defense spending on AI.
But the word accretive is doing a lot of heavy lifting. For an acquisition to be accretive, it has to directly increase earnings per share, right?
Exactly. If you buy a company but have to issue a ton of new stock to do it, and your profit margins shrink, that's dilutive.
Which is tough when you have a depressed stock price and a heavy cash burn.
It's a very difficult needle to thread.
Which brings us to the bear case, valuation compression.
Yeah, if Q3 shows flat growth, or worse, EBITDA, the market's patience is going to evaporate.
And they will aggressively punish that rich 10.96 price-to-sales multiple. The actual usage of the ATM offering just remains this massive dark cloud over all of it.
It really does.
Yeah.
So what does this all mean for the final verdict?
Right. Based on all of this, the final investment rating comes in at a 4 out of 10. That's a neutral, placing it in the lower band.
Yeah, it's firmly a show-me story.
The risk-reward is only there for highly speculative investors who are willing to bet on a Q3 turnaround. For now, the evidence suggests you should wait to see if they can actually translate their acquisitions into operating leverage.
The path to recovery is narrow, but plausible if they execute.
Definitely. And listen, if you found this analysis helpful, please remember to subscribe, like, and comment underneath.
And be sure to check out that 14-day trial for StockOracle in the description below.
Before we sign off, I want to leave you with a final thought to mull over. BigBear.ai highlights a really fascinating reality in this current AI gold rush.
Yeah, the difference between buying tech and building a business.
Exactly. An acquisition can easily buy you flashy generative AI capabilities and a temporary revenue bump. But can you actually buy a durable, competitive moat?
That's the real question.
As the AI sector matures, you really have to wonder if mid-tier players are just going to be forced to continually dilute their shareholders just to survive against the giant tech monopolies. Keep that in mind next time you see a company promising the future while quietly asking for the right to print 100 million new shares. Thanks for tuning in to Smart Wealth with Joshua. We'll see you next time.